And the third one is because of the interest. So if someone has interest on borrowings for acquiring a house property, then there again the benefit has gone up by 50,000 rupees. So therefore, there again the benefit will be 5 to 15,000. So if someone has done all these three, he'll get a maximum saving at 30% slab of 45,000 rupees and a minimum benefit of 15,000 rupees if he is in the 10% slab. Right. Now, this concessional rate of tax on overseas borrowings is quite welcome. Because what has now happened is the condition that it should be only by way of infrastructure investment is gone. In short, any kind of borrowing for any purpose, as long as it is supported by some kind of an agreement or some kind of a paper or a script, that will get this benefit of the lower rate of tax. And that would be a very big boost for foreign borrowings or overseas borrowings. Further, there is another big relief, because earlier what was happening was, if the foreign investor did not have a PAN, except for infrastructure, in all other cases, you were forced to deduct tax at the rate of 20%, because if the deductee, that is the person of whom you are deducting the tax, does not have a PAN number, the mandatory rate of 20% of deduction of tax at source kicks in. That has been exempted for these borrowings also. So those lenders need not subject themselves to getting a PAN in India, which again makes it much easier. Okay, now reduction in tax rate on certain dividends received from foreign companies. See, this provision was originally introduced when Pranab Mukherjee was the finance minister, and at that time, in fact, I had said from the same dais, but people had thought that it was a kind of an amnesty scheme. Why is it a kind of amnesty scheme or a hidden relief for either exporters, you may call it, or those who provide services overseas? I'll give you a simple example. Suppose you are A Limited in India. You render services overseas. What is the tax rate which you will pay? You don't have 80 HHC, you don't have anything else. So your export income or the income from exporting services will be taxed in the same manner and at the same rate as the income which you earn in India. Your global income is taxed the moment you are a resident. So you would be paying tax at the rate of say 30% if you are in the maximum tax slab. If you have a wholly owned subsidiary in UAE or in Singapore or any other place where local income is taxed, overseas income is not taxed. So if an Indian entity goes and sets up there, it faces a 0% tax rate, but it is not a tax haven. If that entity renders the services abroad, what will it get? It will get income, and that entire income will be tax free because the local laws there don't levy any tax on that activity. If that entity remits the entire money as dividend to the Indian company because it's a wholly owned subsidiary, that money comes in and is taxed at the concessional rate of 15%, which is what this section says. Now this section was ending in March 15. It has now been extended without a sunset clause. So it's a perpetual kind of benefit or an amnesty scheme. So it will encourage Indian entrepreneurs to set up overseas entities to carry on business abroad, because whatever income they earn will now be taxed at only 15%. This is already there, it's just been extended primarily. Now this rollback provision in APA actually means that once you end up having a pricing agreement with the government or with the tax department rather, it can be applied to all the pending or the earlier cases also. So it gives some kind of a finality to your dispute. It won't happen that it is prospective in effect only, but it goes back only 4 years. FIIs are given a benefit. Now this benefit is two ways. What is the two ways? The first is that any kind of transaction, irrespective of the form of the transaction or the substance of the transaction, will be considered as capital gains. In short, the fear that it will be considered as business income is now gone. So the moment that is the situation, they will get all the concessions as far as capital gains tax is concerned, which are very low for the overseas investors. Practically nil and otherwise I think 10%. Now what is the other benefit? Control and management of the fund can be located anywhere, because capital gain doesn't change because of control and management, whereas business income changes. So fund managers can stay in India. Otherwise the situation was that fund managers of funds which invested in India had to perforce be residents either in Singapore or somewhere else. They had to stay out of India for at least 182 days to ensure that control and management of the fund doesn't get located into India, in which case it would be taxed as business income. So it is just a relaxation given to kind of get over this kind of artificial response of fund investors. AMT we have already seen. We quickly jump to taxability of advance for transfer of a capital asset. Now this is a big change. Earlier, under the Tax Act, if a person received some advance, you undertake an agreement. Say you have a flat and you want to sell the flat, so you go in for an agreement for that flat. Somebody agrees to buy your flat for 1 crore, and he gives you an earnest money or an advance of say 10 lakhs. Eventually he is not able to raise the monies, or he changes his mind, or something else happens, or maybe the terms are not acceptable, and so he goes back and says, I am not going to buy it. What normally happens is this advance money which is received is generally forfeited, either the entire amount or a substantial part of the amount, because the person in agreeing to wait and not sell it to someone else has lost other opportunities. So say 10 lakhs is paid as advance, it used to get forfeited. Now how was it taxed earlier? Earlier it was taxed not when the advance was received or it was forfeited. It was taxed by way of reducing the cost of acquisition when the asset ultimately got sold. So first of all, if a person never sold that asset, he would never pay tax on that amount. But if he sold that asset eventually to someone else, his cost of acquisition would be reduced. So in short, it would be liable to the same rate of tax as long-term capital gain, which would be 20% at the most. And further, it would increase the capital gain. So if you are going to reinvest in another property, or if you are going to buy bonds and get exemption, you could invest that much more and you would end up paying zero tax. Now what has happened is, two things have happened. One is the tax point has got accelerated. So the point of taxation has become the year in which you receive that amount. So in short, moment you receive an advance which you have forfeited, you will pay tax in that year itself. You don't have to wait, or the department will not wait till you actually end up selling that asset. The second thing is, it will be taxed as other income. In short, you will have to pay 30% tax on that advance, and therefore there will be no other expenditure on it. So straight away you end up paying 30% tax on whatever advance which gets forfeited. So again, a setback for people who own assets, especially and whose transactions don't materialize because of some reason or the other. See, the idea that it was taxed this way was, it is something more or less like a compensation for damages, because a person's deal doesn't go through and he suffers because of that. Now that has become taxable. The next thing is tax deduction at source from non-exempt payments made under life insurance policy. Now please understand, the tax department keeps watching you. Now they put out those very repulsive ads which says that income tax department is watching you on radio as well as television. As I told you earlier, probably the view is adversarial, in the sense that a person who is a taxpayer is actually a criminal, and all taxpayers generally like to avoid taxes. That's the assumption with which these ads proceed. So this section is also similar. What has happened is, human policies or policies which are in the nature of single premium, they may not necessarily be single premium, because the moment single premium policies were taxed on maturity, life insurance and other insurance corporations, which are again government arms, came up with fresh policies which said that bulk of the premium will be recovered in 1 year, and there will be some token premium payment in the subsequent years for 2 or 3 years, so that it is not a single premium policy, because you are paying more than one premium. So now what has been provided is, earlier up to March 12 it was 20%, now it's 10%. So if in any year the premium paid exceeds 20, now 10% of the sum assured. Sum assured does not include bonus. So if the sum assured is say 10 lakhs, you have a policy of 10 lakhs. And if at any time, any one premium out of all the premium payments exceeds 1 lakh, the proceeds of that policy are fully taxable. The difficulty is that when the assessing officer is doing the assessment, he has no way of finding out, unless your case is selected for scrutiny, as to what is the kind of policy which you have subscribed and whether you have paid any premium which exceeds 10%. So whether it's taxable or not is not possible for the department to find out. So in reality, no one was paying tax on the maturity proceeds of such policies. So what they have now provided is that there will be a TDS. The TDS amount is small, it's only 2%. There will be a TDS which is mandated to be done by the insurance company when it pays the proceeds of a policy like this. So when the insurance company is paying the proceeds of a policy where it has collected more than 10% of the sum assured as premium in any one of the years, it will have to deduct tax at source. Now what will happen because of that? The department will know from 26 AS, that is from their tax network, that this person has a maturity proceeds of a policy which is taxable. So if he doesn't include it in his income, the money can be recovered from it. So now you cannot any longer get away with getting maturity proceeds of such policies and not paying tax on it. Okay. Now signing and verification of returns. What has happened is there are a lot of changes which have happened in forms, including electronic signatures and uploading of forms. Uploading of forms doesn't involve any physical signing. But the Income Tax Act was never amended to recognize that fact. So now the Act is amended and Section 140 is amended to recognize that fact, that it will be considered as a valid way of signing the income tax return. Charitable trusts are facing the biggest hit. Normally it is trusts and societies which run educational institutions like these and also a lot of others. So what is the problem now? Earlier what was happening was that in case because of some technical default or whatever, your section 10 or section 11, either of the two deductions doesn't get allowed and your income becomes taxable, you could still claim exemption by saying that 85% of your income is spent on charitable purposes. You understand? So even if you get income from, same with the next provision, even if you get income from, what is it called? Sorry, here, anonymous donations, whatever way you get income, if you spend 85%, eventually you won't pay any tax. That was the position. But now all those disallowances which are made, for example, if you are carrying on a business and the income or the proceeds exceed 25 lakhs for a trust, and if you get income from anonymous donations, that exemption would no longer be available. So you can't claim any other deduction. Similarly, depreciation. Now, this is a very tricky thing and most trusts used to do that. Suppose you invest monies into infrastructure, like this trust has invested in constructing a building for carrying out educational activities. Normally, because of accounting standards and because of fair accounting, depreciation on all these assets used to be claimed and debited to the income and expenditure account. And it was considered to be included or a part of the 85% application of income on charity. Okay, so if a trust earns 100 crores in a year, it spends 70 crores on charity and 15 crores is the depreciation which is provided in the books on the building which it has, building or other assets which it has. Then it was considered that it has spent 85 rupees out of the 100 and exemption was provided. Now what do they say? This depreciation of 15 rupees will not be counted for calculating the 85%. It will not be allowed as a reduction. In short, now they want 85 rupees physically spent out of 100 rupees collected. So if you have a depreciation of 15%, practically it will mean that you have to spend all your money. Okay. So that's a bit of dicing use for trusts. Similar clarification is there for 1023C. Apart from the fact that earlier there was no definition about substantially financed by the government. So there were a lot of disputes. So now they are going to provide a percentage that if financed by the government for a particular project or a scheme being run by the trust exceeds a certain prescribed percentage, it will be considered as financed by government and only then the tax benefit will be available to it. Cancellation of registration. This is again very wide powers given. On the one hand, everyone talks of kind of level tax playing field and minimizing discretion in the hands of officials. Now what has happened is, earlier registration once granted was valid for a lifetime for a trust, and it could be cancelled only in specified situations. Now there are 4 conditions added. What are those 4 conditions? In case it is established, if the income does not inure for the benefit of general public, it is for benefit of any particular religious community or caste, any income or property of the trust is applied for benefit of specified persons like author of the trust, trustees, etc., or its funds are invested in prohibited modes. Now I can understand the subsequent 3, but the first one is very difficult to interpret. It says the income does not inure for the benefit of general public. Now general public is never defined in the Income Tax Act, nor under the General Clauses Act, nor anywhere. What could happen is, they could say that, oh, this trust only functions in this small area, so it is not really for the general public. Now, it will all depend on what interpretation the principal commissioner at that time gives to the word general public. So what exactly is general public? This is going to open a lot of plethora of litigation. So whether the benefits of the trusts are going to a wide community, that is general public, or not, cannot be clear. So therefore, trusts which are aimed at giving benefit to a particular class of people may not now get the exemption. I mean, if the principal commissioner takes it into his head, he may cancel the registration, saying that it's not for general public. So that's going to be a bit of a challenge. Anonymous donations we have already seen. Now, that is another thing I want to point out here. Fact, this is classified as a rationalization measure in the budget. Can any one of you tell me? It gives me a chance to drink of my tea also. What's a rationalization measure as against a taxation measure? Your classification in the budget, have you noticed it? There are some which are classified as welfare measures. There are some which are classified as measures which are aimed at widening the tax base. You must have kept track of the titles. See, if you look at the titles, there are various things mentioned. There was widening of the tax base and anti-avoidance. So here it is, rationalization measure. All these are classified as rationalization measures. Are they rationalization measures? That's a question of mine. So what I am trying to say is, it's a euphemism. What does this provision say? Earlier, a transaction was considered as international if one of the parties to it was a non-resident or an entity which is an overseas entity. Now they say which is related. So related party has been defined. So it is between related parties and one of the parties is overseas. Now they say it will also cover an unrelated party with whom a prior agreement exists. In short, it now extends to even unrelated parties. If there is a prior agreement with that party in respect of any transaction, what that would mean is, effectively the moment I have an agreement with any party, for subsequent years that party will become a related party, and so the transactions will be covered in this scope. So it's indirectly saying that all transactions with non-residents or all overseas transactions will now come under transfer pricing concept. So it's actually a measure aimed at widening the base rather than rationalization. Same is the situation for the earlier clauses, but it's classified as I don't know what kind of rationalization has happened here. Okay, next is levy of penalty under 271G by transfer pricing officers. This is again related to international transactions, that is transfer pricing. Earlier the penalty had to be levied by the assessing officer because the act did not permit levy of penalty by the TPU. A person who cannot levy penalty doesn't get appropriate feedback and response. So if you didn't file details with the TPO, there was not much he could do. So now he can levy a penalty on you directly. Now, applicability to earlier years of the registration granted to a trust. This is the only plus benefit which has come to all trusts. See, what has happened is, after the amendment, few years back, 4 years back to be precise, trusts could not get themselves registered of an earlier date. So all registrations were prospective. So if a trust fails to get itself registered, it's carrying on activities, and suddenly, well, it discovers that it needs to be registered under the Income Tax Act to get tax benefits, it goes and registers itself. The first thing which assessing officers used to do is, oh, when was the trust established? In 1952. You are applying now for registration. So let me open up all your earlier cases, because earlier years your income is now taxable. So they have just clarified that if the trust was for the same objects, carried on the same activities, and otherwise generally satisfied the conditions provided in section 11, even if the registration is granted now, it will apply for earlier years also. So nobody will open your old cases just because you now go in for registration. Now the only hope is that this enactment is also extended to 1023C, which also covers certain kinds of trusts. But currently it is for 11. CSR, a small setback. CSR was earlier allowable under section 37. What was that? Principle of commercial expediency. See, if you are a company which is working in a particular area or a particular environment, it is always advantageous for you to do something for the people in that area that will create a goodwill in your favor, and your functioning will become easier. A lot of arguments from the tax department saying that this is not expenditure which is incurred wholly and exclusively for the purpose of business. Show us the business connection. So they explained, look, I am working in a backward area. If I do not do something for the tribals or for the villagers there, they will not allow my trucks to pass. Because the trucks have to come through that area in order to come to my factory gate. My people will not be able to report to work. We will face a lot of animosity and ostracism in the community in which we live in. So therefore, for smooth functioning of my business, I need to spend money on social activities in my area, and that makes business sense. So it was definitely allowable under 37. What does the budget speech as well as the clause by clause say? It says that since CSR expenditure is not wholly and exclusively incurred for the purpose of business, it is not allowable under 37. Hence, this provision is a rationalization measure. So now section 37 clarifies that CSR expenditure is not allowable under 37. So in short, you have taken away that. And now what does it go on to say? That it will be allowable only to the extent available under 30 to 36. So you can now do only that kind of CSR which fits in under 30 to 36 as allowable deduction. You can't do general CSR in an unfettered manner. You will end up losing the tax exemption. So in short, what they are trying to say is CSR is mandatory 2% as per the Companies Act, and CSR is to be done out of your post-tax income. Don't do it and claim a tax deduction on it. So that will be a double whammy for companies. They will have to spend 2% and they will not get a tax rebate for it. Anyway, fine. Disallowance. See, this is the fine print which never finds place in the reactions and the newspapers. Disallowance of expenditure for non-deduction of tax at source. Here again there is a permanent deduction which has come in, but it's a welcome change, I would say, for those who never intended to pay the tax deduction at source anyway. I'll explain how. Earlier, disallowance was 100%. So what happens is, if I pay expenditure, or if I pay say commission or some other expense, say professional fees to someone, and fail to deduct tax at source, I can't claim it as an expenditure in my profit and loss account. In short, I can't claim it for calculation of my tax. So for not deducting 2% or 10%, my entire expenditure was disallowed. But there was a proviso. What was the proviso? That I could get the deduction in the year in which I actually deducted and paid the tax. So if I have failed to pay the tax and I pay it subsequently, I will get it as a deduction in that year. Now there is a small change which is done. What is the change? That deduction which was earlier 100% has been brought down to 30%. In short, say I pay 100 rupees to a professional, I failed to deduct tax at source on it. So 30 rupees would have been the disallowance earlier, 30% of 100. Instead of that, it will be 30% of 30, that is 30%. So the actual disallowance will be only 9 rupees. So in short, if I fail to deduct tax at source on 100 rupees, 30 rupees get disallowed. The second concession given is that just like for residents, I could deduct and pay the tax before the due date of my filing of the return. See, normally tax is required to be deducted immediately when you make the payment, and it has to be paid by the 7th of the next month. Instead of that, even if I paid before the due date of filing of the return, the tax benefit was allowed for the expenditure. Now that has been extended to payment to non-residents also. So earlier, non-resident payments, you could not claim deduction if you have not paid immediately. If you paid subsequently, it was not allowed. Now it's going to be allowed. But now they have widened the scope. For example, salary payments without TDS were allowed earlier as a deduction. Now that disallowance has been extended to salary, to directors' fees, to royalties, etc. So the net is widened. Now TDS, there is one more provision which has come in. See, correction statements could be filed online. Now this is like a revised TDS return, but it was not called a revised TDS return. The Act didn't provide for that. So now the Act provides for it, but there is a time limit. You have to file revised TDS returns within 7 years. That is correction statements. Now this business of plying, hiring and leasing goods carriages per vehicle was different amounts were there. 4,500 for small vehicle, and for heavy vehicle it was 5,000 per month. So in short, if you own a truck, you ended up paying tax on 60,000 rupees. That was your income. So if you had 10 trucks, 6 lakhs was deemed to be your income. Now it's raised to 7,500 for all kinds of vehicles. This is one more change which may significantly impact how you account for, especially for those entities which are not audited. See, if you are a company, you have to follow Companies Act. There is no two opinions about it. But if you are a non-corporate entity like a partnership firm, now there is going to be income computation and disclosure standards which will be notified under section 145. And if those are not followed, then the assessing officer can make a separate assessment by leaving your books of accounts aside. So let us see what kind of standards are notified and what kind of accounting treatment is provided. So there could be some income computation standards which shortly may come in. Now SUUTI is not something significant. UTI gets a retrospective exemption. This is a good one. Exactly the same transaction as the Vodafone case. If it happens in respect of government securities, it will be considered as exempt. So although they have taxed Vodafone, now they are saying that if there is a transaction in government securities which happens abroad and the government securities are lying here, or basically an Indian asset, still it will not be considered as taxable. Okay, then speculative transaction in respect of commodity derivatives. It's a benefit, but it's also a hit for those who have earlier considered it and been taxed as speculation. Let me explain to you. What is a speculative transaction? A transaction where you buy and sell commodities or anything without intending to or without actually taking delivery. In short, I agree to buy, I agree to sell, or I actually buy or sell, but I am never going to take a delivery, so I am going to square up the transaction. That is a speculative transaction. Now what they have said is, if a commodity transaction is done in respect of derivatives online through a registered broker and various conditions are mentioned, that is, the PAN has to be quoted and the distinctive number of the client has to be quoted, then in that case it will not be considered as a speculation transaction. So that's good news. So people who deal in commodity derivatives now can show it as business income. So if they have a loss, that can be set off against business income. So that's a benefit. But what is the problem? People have accumulated speculative transaction losses up to last year. Now this year onwards it will become business income. So I can't set off those brought forward losses against anything. So those losses are going to go now. So that's the unfortunate thing. Probably they could have given a window period for claiming the set off, but that has not been done. Now capital gains arising from transfer of an asset by way of compulsory acquisition. This is really a welcome change, I would say. See, what has happened is, government takes away your property, an interim award. First the land acquisition officer will give an award and say that okay, this property I'll give you 1 crore. Then you file an appeal, that tribunal gives you 2 crores or 3 crores. Then you go to the court gives you 8 crores. And ultimately it goes to the Supreme Court, maybe again it comes down to 4 crores or whatever else may happen. So this is the kind of movements which happen in the awards. Earlier there was no clarity in the sense that the department used to tax the compensation whenever the first installment was received. Now see, I have a problem here. What is the problem? I have received 1 crore as an interim award. I don't know whether that 1 crore is going to remain or it is going to come down. Why should I pay tax on it right now? That was the thought process of the recipient. The second thing is, if I invested it in something, I would claim a set off and I won't pay tax on it. But how can I do an investment of 1 crore when I know that the property value is 4 crores and eventually I am going to get 4 crores as my award? So that created tremendous problems for the people whose property was compulsorily acquired. So now it has been provided once and for all. The compensation, interim enhanced compensation, whatever monies come in, everything will be taxed only in the year in which the final order of the court comes in. So till that time you don't have to pay any tax on it. It will get taxed only in the year in which the final award of the final court comes. So if the matter is going to go up to Supreme Court, when the Supreme Court award comes, only then your amount will become taxable. So probably for many people, compensation will become exempt from tax, because by the time the Supreme Court judgment comes, it takes 30, 40, 50 years, which goes beyond the lifetime of the people who are already 35, 40 years old. So therefore they will never pay tax on that compensation in their lifetime, but they can always use it any manner they want. Fine. How much more time? 5 minutes. Yeah. Now, cost inflation index, they are going to remove the consumer price index for UNME. That means now cost inflation index will become even less attractive, in the sense that you will notice that in the last few years the cost inflation index for calculating capital gains tax has been rising by an average 10%. But now if your consumer price index is knocked out from it, only the WPI will remain. So it will come down to 5%. In short, you will be ending up paying some tax on inflation. Now, this is a bit of a bad news. It's a clarificatory section. Capital gain exemption in case of investment in residential house property. You know, under 54 and 54F earlier, the provision said that you could invest it in a residential house. A residential house has been interpreted by courts to mean more than one house. So if a person is living in a bungalow, he sells the bungalow, he needs to buy 2-3 flats in order to accommodate. As long as they are contiguous or probably have a shared kitchen or are in the same locality, investment in more than one flat was allowed. Similarly, a person who wants to settle abroad with his children or for some other reason could even buy property abroad, and that was also allowed as a deduction, because it didn't say a residential house where, in India, outside India, etc. So you could sell your house in India and buy a house in UK. Now two things are made clear. It says one residential house situated in India only, which means that if you buy 2 flats, after selling 1 flat, you will get a deduction only for the one of the 2 flats which you have bought. So you will end up paying capital gains tax. That's a problem. The second thing is, if you buy a property outside India, you will not get that benefit. So you have to buy the property in India only. So some hardship for urban people, because the difficulty is builders make small flats. If you want a bigger flat, they will say we will combine. So your agreement will have 2 flat numbers. The moment it has 2 flat numbers, you are not going to get a deduction. You have to tell the builder to get the approved plans amended and convert it into a single flat before acquiring it, which is a tall order, because builder will say I can't go again to the municipality and get the plans changed. That's going to cost a lot of money. Who's going to bear that cost? So it's going to be a big challenge for people. Okay, now specified bonds. People used to claim that 50 lakh deduction twice or exemption limit twice. Suppose you sell a capital asset in February. You are supposed to invest in bonds within 6 months. So what I did was, I put 50 lakhs in March and again I put another 50 lakhs in April. They are in 2 separate financial years. So I could claim 1 crore deduction of investment in bonds. Now the section is amended, saying that the total deduction, even if it is spread over a number of financial years, does not exceed 50 lakhs. So it's just clarificatory in nature. Now this speculation business is not great. This is something I wanted to comment on. Now you have a principal chief commissioner of income tax. So they are just increasing the post probably, or this is just sinecure. I mean, the powers have not changed, nothing has changed, but now the chief commissioner will be called the principal chief commissioner. So there will be more chief commissioners. See, today already in the city of Mumbai, where in 1952 there was only 1 commissioner for the entire Bombay region, today there are about 100 commissioners. and there is only one chief commissioner. So probably there is some disgruntlement among the ranks. So now there will be a principal chief commissioner, there will be about 20 chief commissioners, and the rest will be commissioners. So that's a change which has been made. So I was just thinking, after a few years you have a primary principal chief commissioner, and then you would have a primary main principal chief commissioner and things like that. Doesn't really make much of a difference. Yeah, one more enlargement of powers. See, the power of survey was given only to the assessing officer with prior approval of the Director General or the Chief Commissioner of Income Tax. Now this has been extended to TDS and TCS officers. In short, tax deduction at source officer who has no jurisdiction over you otherwise, is not your assessing officer, can also carry out a survey at your premises. Similarly, a tax collection officer can also carry out a survey over your premises. So expect more visits by way of surveys. That's what it means actually, nothing beyond that. Mutual funds, or I could say that those people were feeling left out, punishment posting, we can't go for a survey. Okay, so you also go for a survey now. Now mutual funds, securitization trusts and venture capital companies to file returns of income. So although their income is not taxable, if their income exceeds the minimum amount not liable to tax, they will have to file returns. Last one, because these are all just procedural sections, so we need not go into that. I just have a particular, See, what has now happened is there are some procedural changes also which have come with the budget. They are not discussed in the budget speech, they are not there in the Finance Act also, they have all come by notification. The first is mandatory e-filing if income exceeds 5 lakhs for individuals and HUFs. Mandatory e-filing for firms and other entities irrespective of level of income. Change in registration procedure for e-filing limit. Earlier you could give any number of email IDs, any number of e-filing could be done giving the same email ID and mobile. Now there is a limit of 4 which has recently been increased to 10. So if you want to give your email ID and mobile number for e-filing a return, say of people in your family, you can't use it for more than 4 returns. So if a family has more than 4 returns, you probably have to use more email IDs or more mobile numbers. Similarly, there is a change in Form BB of the Wealth Tax Act. Now that form requires you to give an itemized list of the jewelry, an itemized list of all assets, and also give the cost of acquisition of that. In fact, to the extent that even the weight of the stones, the weight of the gold, all kinds of stuff is required to be given. So for people who are liable to wealth tax, it's going to be a tall order. In short, you have to get a valuation report done every time. Although the law says you can do it once in 3 years. How are you otherwise going to give the weight of the gold, the gross weight and the net weight and the weight of the precious stones and the description of the stones? That is something difficult to do. So hopefully if you are not liable to wealth tax, you don't have to bother about it, right? Okay, I think I wind up here. Thank you.
Thank you so much, Dr. Kandarik, for sharing your views on the budget and a very detailed analysis of the union budget. Our next guest for the day is Mr. Winston Narona. He has almost 20 years of experience in the financial services sector with wide experience in Tata Finance, ICICI Bank, Standard Chartered, and he currently works with IDFC Mutual Funds as Associate Director of Learning and Development. Mr. Narona believes firmly in simplifying concepts and in bringing in a conceptual understanding of complex financial subjects. I welcome Mr. Narona on stage.
Okay, thanks for coming here, and thanks for inviting me over. I'd like to thank Dr. O for having me over. I'm going to discuss the budget from a very different angle. I'm going to look at the budget from the fiscal. And when we look at the budget, we normally think it's a document which lays out how it's going to impact. Mostly Mr. explains to you, at least in the first half, how well your country did on management of its money. So when you use the word fiscal, we are primarily using this example of how well your previous CFO, that's the outgoing CFO, managed the money, and how well I'm going to manage the money. So a lot of the taxation, a lot of the explanation is given on the basis of how well the country's finances are managed. That's the derivative of the word fiscal. I'd like to start with an understanding of what actually happened previously. So, what is the current economic scenario? So, what you feel, what you get is what has happened before. We know that the economic scenario is going down. It's sub 5. When I say sub 5%, and I'll explain to you what it means a little later. We know that we are not doing as well as we were doing, let's say, 5 years ago. We have inflation which is impacting us to a large extent because prices are rising, and I'll explain to you how financial management improves or reduces inflation. What are we going to do? So this is what we already have. What the finance minister is telling you, this will improve. We think that it will go, our growth rates will go at above 7%, and we believe our economy will stabilize. Okay, that's what he's saying. So most of the understanding is that if you see what has happened to a deficit, and I'll explain to you what deficits are in a few minutes. The deficit has reduced. So what is the deficit? Okay, and we believe that our trade with people abroad, because you cannot running yourself, trade with people abroad will improve. Now, this is the broad fiscal deficit targets. What your finance minister tells you he's going to do this year. He's saying that I'm going to bring my fiscal deficit down to 4.1%, and I will keep reducing this. Now, why is the fiscal deficit important? So fiscal deficit is important if you understand the fiscal deficit is a loss the company makes for running its business. Okay, mostly if you have a company that continues to make losses in the business, it's not a great company to be in, isn't it? Because if your company keeps making losses year on year, what will happen to your company's value? It will deteriorate. Now, every year for the last 60 years, India as a company has been losing money. How does that impact us? So if your company keeps losing money for 60 years continuously, how does it impact us? Okay, one of the biggest impacts is that your value of your currency or value of the rupee keeps dropping. Okay, and I explained to you how that works. So, when is fiscal deficit good and when is fiscal deficit bad? A fiscal deficit or a loss made is extremely good if you are going to take a loss. So, imagine you have an income and you have an expenditure. Your income is not substantial, correct? So, it's let's say 5 lakhs of rupees. Your expenditure is 6 lakhs of rupees. Is that good? Okay, what if I tell you that out of the 6 lakhs, 3 lakh rupees goes towards building a house for yourself? Then is that income good? Expenditure good? Yes, because you are building assets, and that asset building will improve your standard of living in the future. Unfortunately, if your fiscal deficit doesn't go towards building your future, you are basically borrowing on today's assets for consumption. It's like saying, I will sell my house today to go for a foreign tour. Okay, so building assets versus doing consumption. Okay, let us look at how our Indian company, how India is actually using this fiscal deficit. Okay, so what are the roles of the government? The government has a lot of roles. So if you look at the MOA and AOA of your country, okay, the constitution, okay, what it says is that we will provide for the welfare of our citizens. And you do that by ensuring that your citizens have higher income, are able to live better lives through infrastructure, will get the ability to do business better, okay, get better chances of employment, ensure there is equality, and that's part of your constitution, and ensure that we keep building the assets of our country. The reason we want to build assets of our country, because if you build assets, you get richer. So a country who's rich or a person who's rich has more assets. Okay, so that's the mandate of the government. Okay, the government uses the income he earns from you to do this. So if you look at the income of the government, the income of the government is approximately 13.68 lakh, 13.68 lakh crores. Okay, what you see here, that's all in crores by the way. Revenue receipts. Revenue receipts are receipts made from taxes. So when the government taxes you, he earns some income. Now the revenue receipts are about 11.89 lakh crores. There's 11.89 lakh crores, but technically it's about 13.68 lakh crores. Now, what's the difference? The difference is when the revenue is collected, the revenue is distributed into portions. So some portion of the revenue goes to the states and some portion goes towards the central government. So what I'm going to discuss is primarily the central government balance sheet profit and loss account. So what you see here is the central government's profit and loss account. What you see is the government earns most of its income from taxes. So if you look at the revenue receipts, which is the taxes, there are two different types of taxes, direct and indirect. I'll go into that a little later. Approximately 9.77 lakh crores. 9.77 lakh crores is earned through taxes. The other non-tax revenues, which could include a lot of dividends, interest, etc., earned, works out to about 2.1 lakh crores. So you technically earn a total revenue receipt of 11.89 lakh crores. On the other hand, there are capital receipts. What are capital receipts? Capital receipts are receipts made when the government sells something, okay, or the government sells. So when the government does a disinvestment, that's a capital receipt. It can also sell some assets which could be foreign currency bonds, could be some securities. Now, if you look at the other receipts, in this case it is 63,000 crores. So when the government says it's going to do a disinvestment, that's it at 63,000 crores. If you look at the government's expenditure versus income, okay, and the expenditure is given down there. There are two types of expenditure. There is a non-planned expenditure and there is a planned expenditure. I'll get into that in detail a little later. You will see that the government spends approximately 18 lakh crores when it earns something like 12.5 lakh crores. Okay, so the government earns 12.5 lakh crores and spends 18 lakh crores. What will the government do? It will have a deficit, and the deficit there is approximately 5.5 lakh crores. Approximately. Now, if you have to cover this deficit, what does the government need to do? It needs to borrow. And the capital receipts you see there is borrowing. Can you see that there? 5,31,000 crores is what the government borrows. Now, the government has had it was a loss making for the last 60 years. Every year it has been borrowing. Okay, which means this year it's going to borrow 5,31,000 crores. Last year it borrowed 5,24,000 crores, and a year before that it borrowed 5 lakh crores. In the last 3 years, the government has borrowed or will borrow 15 lakh crores. What it implies is that every year the government keeps borrowing more and more money. What will happen if you keep borrowing more and more money? If you keep borrowing more and more money, you will keep getting deeper and deeper into a debt trap. Okay? Now, how will that impact us? I will discuss this a little later. But this is the scenario today. The scenario today is that as we run our country or run our company, we keep taking on these larger and larger loans. If you see the fiscal deficit in the last few years, it has been coming down. It's been coming down from 4.88% to 4.1%. What is this 4.8% built on? Okay, the 4.8% is built on the total GDP of your country. The GDP of your country today is approximately, the way they projected it for this year, is approximately 130 lakh crores. It's about 128 lakh crores, but for thinking purposes, you use that 130 lakh crores. This is your GDP. GDP basically tells you how much income your country has earned in a whole year. The tax you earn is based purely on the income, correct? So when you tax your country, your tax is based on your income. So if your income is 130 lakh crores and your GDP to tax ratio, tax to GDP ratio is about 10%, what is your tax income? 13 lakh crores. That's what you see there. So your 13 lakh crores is your tax on GDP. Now, your fiscal deficit is a function of the loss your country makes on the basis of its income. So if your income is 130 lakh crores, 4.2% of fiscal deficit. So you have a fiscal deficit is based on a country. Why is it based on your GDP? It is based on your GDP because it's assumed that if your GDP keeps growing, out of your income, you'll be able to service this a lot better. It's like saying, this year I earn 13 lakh crores. I have an EMI, or this year I earn 13 lakhs, I have an EMI of 6 lakhs or 6.5 lakhs. That's 50% of my income. Is it tough? Yes, it's tough. But next year, if my income grows from 13 lakhs to 15 lakhs and I do not increase my EMI payments as a proportion of my income, automatically my servicing capability goes up. If I continue to grow my income, my servicing capacity automatically gets better and better. So, as a good, prudent individual, you will look at using loans to buy great assets, and if you buy assets and your incomes keep rising, your ability to service this income keeps going up. Unfortunately for us, our income servicing has gone a little way out. So let me show you what has happened to our fiscal deficit over a long period of time. From 2000 to 2014, this is up to last year, your fiscal deficit has kept rising. The blue line below shows your income. The orange line above shows your fiscal deficit. It has kept rising. And what has happened to your fiscal deficit as GDP? As you can see, it kept going up and dropped down in 2008. When our GDP was growing very fast, automatically our fiscal deficit kept dropping. However, when your GDP stopped growing, when your income stopped growing, it started rising up again. Now the intention is to bring that fiscal deficit from where it is today to approximately 3.26% in the future. Just bring down your fiscal deficit. What implication does it have? So let me look at the government receipts in two different ways. So I've already shown you the government receipts. There are revenue and there's capital. Your revenue expenditure is to tax, direct taxes, indirect taxes. Your direct taxes make up approximately 53% of the income, and indirect taxes make up about 47% of the income. Now, why this is important? It's after almost 5 decades, you are suddenly seeing direct taxes outstripping indirect taxes. If you ask normally when I studied economics growing up, always they said indirect taxes are more than direct taxes, and that's the assumption. Why? Because this switch over from indirect taxes being more than direct taxes into direct taxes being more than direct taxes has happened in the last 5-6 years. And one of the reasons that has happened is because general incomes have suddenly started going up. Your direct taxes can only increase if your incomes go up, because direct taxes is a tax on incomes, while indirect taxes are taxes on consumption. So India has always been a consumption economy, people using stuff, but we are transitioning from a developing economy into a developed economy, and one of the sides are there on a direct and indirect taxes. So when you look at what the finance minister is doing, he is saying that how can I actually increase direct taxes? And one of the insights you will get from the budget is that his focus on service tax and the focus of all our CFOs on service tax has improved over the last few years. Because if you look at the proportion of your GDP is a breakup of incomes from agriculture, manufacturing and services. Agriculture accounts for 25% and mostly it's not taxed. Okay, Manufacturing accounts for 25%. Again, actually little more than 25%. Again, not taxed. However, 50% are in services. If you are able to effectively target services, automatically your tax kitty goes up. And that's the intention. And as you transition from a developing economy into a developed economy, you're moving from being manufacturing and agricultural based to services based. So that's the insight you get into your this. So these are our revenue receipts. If you look at the revenue receipts, a majority of your income comes from corporate tax. Okay, it's not from individual tax. So yet, if you see the other taxations, income tax is now the second largest proviso from regular taxes. Okay, so though we focus a lot on custom duties, excise, as a proportion versus of customs versus excise, income tax has gone higher, and it will keep rising. One of the reasons it will keep rising, like I said, we are transitioning from a lower middle class or a poor economy into a middle class economy, and that's the insight here. Like I said, the government collects 13.68 lakh crores, about 64 lakh crores, out of which it retains about 10 lakh crores and gives the remaining to the states. Now, what is insightful here is the fastest growing proportion of the tax has been the income tax and the service tax. If you look at the service tax down there, it has gone from 1.3 lakh crores to 2.1 lakh crores in the period of 2 years. That's a 50% increase, almost a 50% increase in 2 years. That's how fast it's growing. The finance minister has been extremely optimistic in tax collection. He believes that the tax collection will rise by 19%, while the underlying economy will rise at 13%. What that says is that if your income grows by 13% and the tax goes up by 19%, it means he will either one, make efficiency of tax collection more, or second, he will widen the scope of tax collection a lot more. So what you're saying is 13% growth in income versus 19% growth in tax means he should be able to get this. I am not here to comment on whether he will do it, but basically to give you an opinion on how he's going to do it. Again, the same thing, I've presented it in a graph to show you how the tax collections have gone up, how the non-tax collection have gone up, and the capital receipts. What is important to know is that when we look at the government and we look at the media noise and we look at the amount of noise the media makes on disinvestments, we would feel that disinvestment should be a large proportion of the budget. Unfortunately, disinvestment is a very, very, very small proportion of the budget. And the reason it's a small proportion of the budget is because majority of it comes from tax. Yet, disinvestments as a rule tend to give out a message, and mostly what the government is doing is giving out a message saying that this year I will meet my disinvestment targets, which means I will be more reform oriented. Okay, and it's as if disinvestment increase implies more reform. Okay, but if you see it go there, you'll find out. The second thing you want to notice about capital receipts is actually sale of asset. Most people would not like your government to sell assets. Okay, unfortunately, the media has turned it around and said, if I sell assets, it's good for the country. Okay, but what the government is doing by selling assets, it's actually reducing its capacity to earn income. Now, why is sale of assets bad? The sale of assets is bad is because you understand the government's main role is to increase GDP, correct? You can only increase GDP if your agricultural income goes up, your manufacturing income goes up, or your service income goes up. To increase agricultural income, what does the government have to do? It has to invest in irrigation facilities, dams, culverts, canals. If it wants to increase manufacturing facilities, it has to invest in logistics, roads, ports, and ways of, and communication. If it wants to increase services, it has to invest in human beings, manpower, hospitals, educational institutions, and services. Now, all this requires money. If it is not able to put money into the services, it becomes very difficult. Now, one of the reasons for doing the nationalization of a lot of economic industries is the assumption that by nationalizing, the government would put more effort into increasing these services. It did work for some time, but obviously now the government has taken a very different talk. The talk today is about PPP. And one of the reasons the talk today is about PPP is because the government just does not have money to fund the capital. Public-private partnership means that the government recognizes that I do not have the finances to build more capital assets, and I will need money from abroad, or I will need money from residents. So the Delhi-Mumbai corridor, for example, is funded by the Japanese. Okay, a lot of projects like NHAI, the power grid, etc., are funded by individuals. Now, why is that come to pass? That has come to pass because of the government's expenditure. If you look at the government's expenditure, there are two portions. One is what we call the planned expenditure, and the second is called the non-planned expenditure. The planned expenditure are expenditures normally made with a plan. And most of this plan is towards building assets, building roads, culverts, canals, etc. The non-planned expenditure is everything outside that. If you look at the planned expenditure versus non-planned expenditure, you will notice two things. Which is better, planned or non-planned? Planned. 1/3 of your expenditure goes towards plan. 2/3